Okay, hello everyone. This is Darris Cassidy, again, principal at Verivest and our Chief Revenue Officer. So thank you for joining us today. Well, I said us. My partner Matt Burk is going to join us, and if you've participated in any of our past webinars, you know that Matt doesn't have the link to the Zoom, and it's going to take him another few minutes to figure out how to log in. So it's pretty much how we start every webinar here. So with that, after roasting Matt for a second there, I will get started. Today we're going to talk about fund readiness. What does it mean to be ready for a pooled investment fund, to launch one? Why would you consider it? This can mean different things to different people. We talk to managers all over the country every day that are kind of in this process of wondering to themselves and to their partners and whatnot, to their investors, whether or not they are ready to start a fund or if it makes sense. And maybe ready is not quite the right wording to that, depending on your situation. So it can be different for each person, but really what we're going to talk about here today, we'll come back to that once Matt gets a link and joins me, then I'll introduce him. So what we're going to talk about today is what does it mean to be ready for a fund? Who should not start a fund? I think that's one thing we can tackle pretty quickly. Who should start a fund? What's your investment strategy? Fund economics to consider, capital raising things to consider, administration, investor relations, and then we'll wrap it up from there. So with that, again, I guess we'll come back to that once Matt joins. But so before you kind of get going on whether or not launching a fund makes sense, a lot of times I think of this kind of like how pilots have their checklist to get ready to take off for a flight. I think there's a lot of things to consider. There's a lot of things that we find managers are not fully aware of when it comes to funds. So some of those are the things we're going to talk through today, just to make sure that you're prepared if you are going to launch a fund. And this is a big part of what we do at Verivest, is to be able to talk with managers, help them assess this. We actually have a tool on our website. It's free. It's called a fund readiness audit, and you can go on there, take a test. There's about 30 questions, probably takes 5 to 10 minutes. And that will kind of provide some feedback as to how ready or not you are for a fund. And then if you want to talk through that, why certain answers came up the way, or results came up the way that they did, we're happy to do that. So with that, let's just jump right into it. So what does it mean to be ready for a fund? Again, this is those that generally you have been doing syndications, you have some sort of strategy, you've raised some amount of money, you generally have a team around you, and we'll get into the details of this as we go here. So that's what we mean ready for a fund. I mean, you're committed to it. This is a huge endeavor for people to take on. So it's not something to take lightly. It's not something to launch and start going down the path of raising capital, putting assets into the fund, and then decide that it isn't really for you. That's going to put not only you, but your investors in a really bad situation. So you really need to make sure this is the right path, and make sure that you're ready for the commitment and that it's going to take, because funds go on for several years. They take a lot of work, and the challenges that come up are often things that people don't consider prior to launching a fund. That all said, if you are at that stage to commit to it, put in the work, then and here's Matt. So we'll back up for a second to introduce him. Anyway, if you are prepared to put in the work and commitment, then a fund can be really rewarding. So that's what we'll go through. So Matt, thanks for hopping on and joining us.
Technical difficulties.
Well, we started off by reminding everyone this is how most of our webinars begin, with you looking for the link to join the webinar.
Well, yeah, am I a panelist? Am I a host? Like, so anyway, here I am. So sorry.
That's okay. All right. So with that, we'll back up to the introduction of Matt and myself. Matt Burk founded Fairway America back in 1992. He's run several pooled real estate investment funds. I have been with Fairway America and Verivest going back to 2012. I'm a principal of both companies and have played most of the roles at Fairway, including CFO, managing director of the funds, and really have primarily been the lead capital raiser for Fairway for quite some time. And a lot of all of that is really what translates over to the Verivest side of the business, where we provide services to managers to help them create funds. We'll help them administer their funds on an ongoing basis. We have an online investor portal, as well as some additional services to help managers grow and scale their funds. And ultimately, that may lead back to Fairway America considering making investments into the funds and fund managers that we work with. So that's how the two companies are tied together. So today, for the purposes of this webinar, will be focused more on the Verivest side and the services that Verivest can provide, and to help with some education around whether or not you're ready for a fund. So again, verivest.com, I mentioned just a moment ago, you can find there a fund readiness audit. So quick little test if you want to go through about 30 questions to determine whether or not you are ready for a fund. And I understand, Matt, you just saw an email. You just did the fund readiness audit for the first time a few minutes ago. So I presume it said you're ready to launch a fund.
It's funny, as Kellen just came in, and he's like getting all excited as he got one of those that came in, and then he got to the bottom and saw that it was me.
Like, wow, this guy's really qualified.
Yeah, hey, this guy's ready for a fund. So yeah, I just did it to make sure I knew what I was talking about here when we get on this webinar. But it is a tool. Like, we created this tool years ago, right? And we used it in different versions, and I think today it really is helpful in just terms of figuring out, like, am I actually ready to start a fund? So it's a quick, easy thing that people can use to just, it's not the be all end all, but it's a good guide as to whether you might be ready or not.
Yeah, and that's kind of what I mentioned before you hopped on, is that you may have some questions about why the results are what they are, and really there's three outcomes to it. One is that you're not ready for a fund. One is, well, you may be ready for a fund, but there's a few things you might want to improve on or consider. And then there's the third option, which is you are ready for a fund based on the answers that you've given. So with that, that's what we'll focus on here. We kind of talked about this. We talked about what it means to be ready for a fund, and the commitment that it takes to run a fund is a big part of that. Not only your experiences prior, but really being ready to commit for several years to running a fund. So let's hop into who should not start a fund. This is something we see quite a bit. I think there's some myths or some misconceptions out there in the market as to what it would mean to launch a fund. So maybe let's talk through, Matt, kind of who should not start a fund. I mean, the one that we hear quite a bit are people that come in and think that if they launch a fund, that it will just kind of magically fill up with capital that they'll be able to invest in their strategy. It's obviously not quite how it works. It's a lot of work to raise that capital. So I don't know if you want to touch on that or continue to add some. I have some other notes of other people that should not launch a fund, but that's a good place to start because that's the one we see the most of.
Yeah, I mean, I think translated, it's if you need to have a strategy for how you're going to raise the capital for that fund. I think I see a lot of people who, in fact, when I ask the question, why do you want to start a fund? The answer is often, so that I'll have the money sitting there available. It gives me more negotiating power in the marketplace with sellers, right? And I don't have to scramble around to find the money and on a syndication because I got a tight timeline, right? And it's very stressful to be both trying to close the deal and get all the money, all of which is true, right? But just because, so my next question to them is, well, what makes you think that just because you launch a fund, the money will be sitting there. And sometimes people have really good answers, and oftentimes they don't, right? They just expect that somehow magically it's going to be showing up. So I think probably the biggest thing is making sure that you have a strategy, which doesn't mean you have to have all the money lined up, right? That's impossible to do, but usually. But it does mean that you at least need to have put some thought into how and where you're going to come up with the money for that fund. Who are you going to market it to? Who's going to do that marketing? Who's going to do that selling? It's time consuming, as you well know, Darris, from having, having spent a lot of time over the years doing that. So I think that's probably the biggest thing, is making sure that you have a strategy for raising the capital. I think other things would be around the type of assets that you're doing and the frequency of those assets. We had one example the other day. We're talking to a potential fund manager, and somebody wants to set up a fund, and we ask them, how many deals are you doing in a year? And they said, well, 1 or 2. Okay, well, 1 or 2 deals per year is really not enough to warrant the cost and the time and the effort to put, the fund together and to raise capital for it. It's just, there's no point in doing it. You might as well just syndicate if you're doing only a handful of deals in a year. And of course, some of that depends on the size and so forth. But I think the asset model and the frequency of investments and the size of those investments is a very big factor in determining whether or not someone should start a fund. And sometimes the answer is no, well, of course, which we tell people if we don't think that they're ready.
Yeah, I think the last one to add here, and I touched on this a minute ago, is really if you're not prepared to commit the time and effort that goes into running a fund, then it's not for you. These are big deals to embark on, and you really don't want to get a fund up and off the ground and then figure out that you're not prepared to run that for several years, because that's going to be a bad situation for you and your investors. So you really need to be prepared for what it means. And we'll talk in a few slides about some of those things, like the economic considerations, to Matt's point, some of your asset strategy considerations. But yeah, you really need to be ready to commit to this. So you can't go in and tiptoe into it, kind of jumping into the deep end if you're going to launch a fund, and need to be prepared to run it for several years.
Yeah, and I think other things would be if we had another one recently where the person hasn't even done a single deal yet, so they've come out of, and you'll see this, people coming out of other related fields, brokerage and so forth, who want to become on the principal side. And our guidance is always, do a deal or preferably several deals first. Jumping straight to a fund model, and if you haven't done a single transaction, is not in my judgment a very good idea, because you want to get the hang of the deal side first before you try to do a bunch of deals in a pooled format, because it's an order of magnitude more complicated.
Yeah, so conversely, we just touched on a lot of these as to who should not, but those that should then start a fund, one of the themes that comes up, it would be someone that has an asset strategy that has some velocity of deal flow, right? Because to your point, if you're doing 1 or even 2 deals in a year, you're probably better off just syndicating those, both because of the cost of it, the vehicle itself, the capital raise strategy behind that, the administration, the reporting. So many reasons to syndicate it. But if you have a strategy that has velocity, and that can vary, I suppose, from 4 deals a year to maybe 100 deals a year, right? There's a pretty big range in what that can mean. But you need to be doing a decent number of transactions within a year to justify the effort and expense it takes to run a fund.
Yeah, and if by velocity, I always, what I'm referring to in velocity is like the frequency with which your deals pay off, right? So like volume, are you doing 2 deals a year, 5, 10, 20, 50? And of course that depends on the kind of deals that you're doing. Private lenders, making real estate secured loans tend to do a much higher volume of transactions than people who are buying, apartment buildings or industrial properties or whatever. For example, right? You might do 100 loans in a year or 80, and you might only buy 3 or 4 properties in an entire year. So if you're buying 3 or 4 properties, I'd say that's about your minimum if you're acquiring assets. Real estate directly. If you're making loans, you don't need, if you're doing 4, 5, 6, 8, 10 loans a month, that's probably plenty to justify, putting together a fund. Then the other question becomes the velocity of those assets. Loans, especially like fix and flip loans, they tend to be fairly short term in nature. So they might only be outstanding for 6 months or a year, and then the money comes back into the fund, and that money coming back into the fund can often be recycled into new deals. So it reduces the amount of money that somebody has to raise if the deals go full cycle more quickly. So that's another consideration, and it ties back to the first thing I mentioned, which is where are you going to get the money? So I think this is why, modeling these things out is really helpful. So you have some sense of how many deals you're doing, how much capital those deals are going to require, whether you're using debt or not either at the asset level or the fund level, and then how fast do they pay off, so that you'll have the use of that money to make new deals with, in the future. So all that stuff needs to be thought through in terms of whether it makes sense to start a fund or not.
Yeah, the other thing I had to that, and you touched on some of the things that go into managing a fund, but it's really someone that has a bit of a team around them. So you don't need a huge team to run a fund necessarily, but there are a lot of components to managing a fund. Some of which we'll touch on in future slides here, but things around capital raising, deal origination, deal underwriting, investor relations, some of the accounting, reporting, tax work, stuff of that nature, some of which can be outsourced, and a lot of which you need to be able to handle internally. And especially if you're doing the volume of deals, having a team to spread that amount of work out to, I think is important.
Yeah, and I'd say usually having more than one principal is always helpful. Sometimes it can work fine with a single principal, but a lot of times if you have 2 or 3 principals that are, handling the real high level stuff, and then a staff, and like you said, Darris, it doesn't have to be a huge staff or a huge number of people, but it's very difficult to do everything by yourself. There's just too much breadth of responsibilities and too many different skill sets required that it does require some complementary capabilities by multiple people typically.
Yeah. And then the final thing, and you touched on this on the previous slide, is just someone that has had some level of success syndicating deals. You don't really want to jump from zero to right into a fund. Doing a few syndications at a minimum is usually a good idea, just to experience kind of the beginnings of what it takes to run a fund, even if it's not in a pooled format.
Yeah, I mean, I think, knowing how and why and when to put the deals together, how to originate and acquire them, how to asset manage them or service them, how to get out of, if you're lending, how do you get out of the default situation, have to file foreclosure, deal with bankruptcies. There's all kinds of things that you learn by doing deals, right? And then it is also helpful in a fund format to be able to point to the individual deals that you've done. It's not a perfect apples to apples comparison in terms of track record, but you're far better off going into raising capital for a fund to be able to point to individual deals that you've done, preferably that have gone full cycle, to investors, so that they see that you can be trusted and that you're competent to know how to do deals. If you haven't done anything, or deals haven't gone full cycle, it's a little bit harder to extrapolate that and point to it when you're raising money in a fund, and it just makes the capital raise that much harder. So, it's not to say that can never happen. It's just as a general rule, I would tell you that's the best bet for most people.
Yeah. So we touched on this a little bit, but knowing your business strategy and why that matters, the volume of deals, the velocity of the deals, the size of your deals all comes into play. A lot of that, it doesn't necessarily matter what asset class you're playing in, whether it's multifamily or retail or storage or something else, but really having an understanding of the volume, velocity, and size, and then modeling that out can help in determining what we'll talk about in a few slides, which are the economics of that fund, what you could expect as a manager, what your investors can expect as far as returns go. And then ultimately, it also can help you determine how to size the fund and how much capital you're going to need to raise and whether or not that's realistic for you at the stage you're at or not. So as an example, if you're closing or planning to close 4 deals a year, $5 million of equity per year, and it's a 3-year investment period, you're probably going to need to target somewhere. Well, I just lost track of my math there, but what did I, 5 million, 4 deals. So $60 million over a 3-year period. And then whether or not some of those recycle during the time period, like Matt said, if they're loans, maybe they're smaller, maybe they are a shorter duration or a term. And so that money can come back in. And then, of course, whether or not it's an open-ended fund versus a closed fund, because the open-ended funds, you can constantly recycle that capital, whereas the closed funds, you kind of have these finite time periods where you're raising, you're investing, and then you're selling off the assets and returning capital plus profits to the investors.
And as it pertains to defining your business strategy, we do have it happen more frequently than people would think, where people come in and I think, I don't know if you commented on this, but I saw it in your notes. The people have this idea that they want to set up a fund, but they don't really have a particular strategy to do it. They just want to set up a fund. And then they'll ask us, well, what kind of a fund should I set up? And I'd say, well, there is no magic answer to that. It's like, what kind of deals do you do? Right. So we want to start with the deals that you do and whatever it is that your strategy is that drives whether or not you should set up a fund. You should not set up a fund and then just pick any old strategy that someone throws out there for you. It's important to understand what is your belief system around how you make money in real estate by doing real estate deals, and then it may or may not make sense to put a fund around that as opposed to the other way around.
Well, and then hearing you say that, my brain goes right to capital raising, and why this is important for capital raising is, you're out pitching investors as to why they should invest into your fund. And funds are very different on the capital raise side. I'll try not to go too deep down that rabbit hole, but relative to syndications, a syndication, you can point at a deal, point at the numbers, point at the time frames, point at the returns, and it's easy for investors to kind of wrap their head around that. Whereas when you're asking them to invest into a blind pooled investment fund, they are investing into you as well as the strategy and story that you're painting for them. So if you don't have that really well dialed in as to what the strategy is, why you have strong conviction about it, and why you like the strategy, it's going to be really difficult to raise capital unless you have this component really firm when you're out pitching investors. So fund economics, there's a number of things to consider here, and we could spend an entire webinar on fund economics. We find that a lot of people do not really understand the economics of a fund. I mean, hopefully they do by the time they have created and launched a fund. We do have a free fund financial model calculator on our website, so you can kind of play around with the high level, really basic fund calculator just to see kind of what it would look like. But there's a lot of considerations that doesn't take into account. So maybe I'll talk you through this, Matt, and make some comments along the way. I think that's probably the easiest way to work through this in an efficient way. But the economics, I mean, really the beginning of that is whether or not it's a closed fund or an open fund. And we've talked about this in previous webinars, but quickly, what are the primary economic differences specifically to the manager in an open fund versus a closed fund?
Yeah, I mean, I'd say in a closed fund, typically the manager is not receiving any of the promotes or the carried interests until the very end of the fund life. When you're doing deals one at a time, the deal goes full cycle, the deal sells, the deal is successful, the manager gets their promote when that deal sells. In a fund, even if the manager or the deal made a bunch of money, generally speaking, all of the money on that first deal that went full cycles goes back to the investors and begins to it catches up any accrued but unpaid preferred return, and it then repays a portion of their capital account. And usually, depending on how many deals you did in the fund, it takes several of those deals before you've paid that capital account back, before you've paid the accrued but unpaid pref, and only then is the manager in the money, right? And so what it basically means then is you're not making any promotes or carried interest until the back half or third or quarter or 10% of the fund's life. So therefore, you need to be able to sustain from the beginning through the origination. And so how you structure those fees becomes really important. Are you charging acquisition fees? Are you charging management fees? What fees are you charging that enable you to employ the people necessary to execute the strategy? And then the quote unquote real money, I mean, the juice is in the promote that is backloaded in a closed-ended fund. An open-ended fund, and this varies considerably from one to the other, but typically, if you are sharing in a promote in an open-ended fund, most of the time that's because that open-ended fund is a mortgage pool fund. The promote is not nearly as heavy as it is when you're buying, value add and adding real estate, but you can at least potentially share in some of the additional upside along the way and not wait all the way till the end. But that's only one factor among many others, and there are other trade-offs that make an open-ended fund, more challenging than a closed-ended fund. So matching your asset model to your fund structure is critical.
Yes. Yeah. So, I mean, to summarize that, just is if you have a closed-end fund, the promote not coming for several years can be challenging for investors, and therefore those fees that you charge upfront and along the way are really what are intended to cover your overhead to get you to the end, so you can get into that promote where the quote unquote real money is. But you need to be cautious and aware of how those fees are going to impact your capital raising. If you're too overloaded them, you're not going to be able to raise the capital. So there's a lot of balancing to that. And this is something that investors often don't really appreciate, or if they do, maybe they don't care as much as to how challenging that can be for managers to get to the end of the fund, to get to those promotes. But
especially a first time manager, right? I mean, like if you're on your second, third, fourth fund, I mean, that those things, then they stagger, right? And over time, then you start, once you're in the money, if you're doing more funds, then from there on out, it's not as big of an issue. But if you're just getting started and this is your first fund, and if it takes you 5 or 6 or 7 years to get to the point where you're in a promote, and to your point, Darris, investors don't really care about what you're dealing with as the manager. By and large, they care about themselves. Like, that's how the world is, right? People care a lot more about themselves than they do about others, generally speaking. So the point is, they will not normally agree to outsize fees along the way. The manager's not, making a bunch of profits and getting fat and happy, during the life of the fund. They're making their money, their real money, at the end when they sell. So you just need to be able to be sure that you've got enough income coming in along the way to survive, to make it, to deliver the value to your investors, to do the work necessary to deliver that return without getting fat and happy along the way, but without starving and not being able to do it either. And that's a very, I think people don't fully appreciate how to do that. And that's why, to your point around considering fund economics, you want to understand this as best you can, because it helps inform, whether you even do it or not. And if you choose to do it, how you structure it.
Yeah. So let's talk about, this question comes up a lot. It's a big topic. People aren't sure how to handle it. But how the whole concept of skin in the game, right? How much capital should managers plan to put into their own funds? What is expected? What is market? How do people do this? So maybe touch on that a little bit.
Yeah, I think there's some interesting material out there about what is considered acceptable amounts. And of course, the more the better from an investor perspective, because it aligns your interest with your investors. But the reality is most managers don't have an infinite, pot of money to put into every deal or into the fund. So I think the best answer that I've ever seen is that, the manager should put in an amount that is meaningful to that manager based on their own personal, financial position. And that amount would be different for different people depending on what that financial position is. So the short answer is the more the better. Some is better than none. And there's ways to do that where it doesn't have to come out of your own pocket. You can partner up with people, bring in other folks into the management entity. That's a big part of what Fairway tries to help a lot of our clients do, is have the manager be able to put seed capital into the fund that is treated pari passu or equal, to their LP investors. So that's the best answer I know of. There is no one magic number.
Yeah. All right, so let's move on to everyone's favorite topic. How are they going to raise capital? I can't think of anyone that we've come across that really has this figured out. It's a concern for just about everyone that I've run across, including people that have been running funds or syndications for a long period of time and have raised a lot of money. Myself included, it's just constantly something that's challenging. It's never easy. I think you figure some things out. There is a difference in raising for a fund versus syndications, which we've touched on in some previous webinars, and I touched on it just a little bit ago, briefly. But I don't know, any high-level comments here as to, how people should think about it before they even have a fund?
Yeah, I mean, look, I know we've done a separate webinar on capital raising, and we continue to talk, about that. It's the number one thing that is on people's mind, right? It's how am I going to raise the money? So again, similar to, the answer to the last question, there's no one way that works for everybody to raise capital. I think if I had to tell you common themes, start with where you're at with the people and work from the inside out with concentric circles, starting with the folks the best. And then the folks that they know, because that transfer of trust is there. The further out of the rings you go, the harder it becomes, but that's when you have to start doing more public facing stuff. And of course, in today's world with the rise of social media and all of that, there's lots of ways that people can do. So I'd say find what works for you and get really good at those things, but be prepared to have to spend significant time and energy on the capital raise side of the equation. To your point, Darris, I'd say, I tell people, look, there's no way that you're going to have it 100% baked, when you make the decision to go to do a fund. So to some degree, there's a leap of faith that you're going to be able to raise the money, but you should at least have some basic understanding of what your game plan is going to be and how much you reasonably think you need and how likely that is to happen to get off the ground and get to a certain point. And then it's just going to be, you have to just keep working at it and working at it and working at it. This is partly why in the earlier section here, we talked about having more than one partner, because a lot of the best managers that I've seen, Darris, they have this is a simplistic version, but it gives you an idea. They have somebody who's focused on the deal side, and they have somebody who's focused on the capital side. And those are full-time activities, right? If you have only two people and they're both focused on the deal side and you have nobody there to concentrate on raising capital, that's probably not going to work, right? And it's almost impossible for brand new small balance managers to go out and find third parties that are going to raise the money for them. So you need to be prepared to do it yourself, and you need to have some sense of how that's going to happen. And then there is some element of leap of faith, but that's the best answer I can give about how to think about it heading into the decision to start a fund.
Yeah, it's kind of funny hearing you articulate it that way, because as a leap of faith, because I recently wrote what is now our capital raise starter kit. It's about a 25-page document of pretty much every single thing that Matt and I have tried to do when it comes to raising capital. And it's a long list of things that we've tried, some of which worked and some didn't work. And some would work for some things that we failed at would probably work for others. And some things that worked for us would not work for others. And so there isn't one magic way to go about it or to do it. But, you and I have taken a lot of leaps of faith through the years, and sometimes they pay off and sometimes they don't, but you just never know. You just don't know, right?
I told some of the stories in the webinar we did on capital raising, so I won't repeat them here. I'm not quite old enough yet, hopefully, to start telling the same story over and over again on a public webinar, but there's plenty of other stories of stuff that we've tried that didn't work very well. So I think a big part of what we try to do is just help people think about it, right? Which doesn't mean there's a magic answer, for us to give everybody that this will absolutely work or this absolutely won't work, right? It kind of depends on your personality, your bent, what you like doing, who and you kind of have to customize it. But the main message to me is just like, accept the fact that raising capital on an ongoing basis in a fund is going to be part of what you have to commit to, and you'd be prepared to commit to it, and ideally have somebody who's dedicated to it 100% of the time, and then your chances of being successful will be much higher than if you treat it as an afterthought, or no one is dedicated to doing it.
Yeah. Okay. Administration. How should people, prior to launching a fund, think about the administration? Maybe even start high level. What is the administration of a fund? Should they consider doing that themselves? And if not, why hire a third party? And, full disclosure, Verivest does third party administration, but whether or not it's Verivest, my vote is that everyone should use a third party administrator, not only because it's the best practice, but just for the complexities that go along with accounting, and the accounting of a fund is a lot more difficult than people appreciate and recognize. And learning that, along with learning how to manage a fund at the same time, I think managers are better off focusing on the fund and real estate and leaving the administration to CPAs and professionals that do that all the time. So,
yeah, I think I would say it's interesting as we talk to people about administration, especially first-time managers. They don't necessarily even know what it means, but they have an intuitive sense that if I'm starting to take in multiple investors at different points in time, and I'm also funding multiple assets also at different points in time, how do I track and allocate those capital accounts, that income, those expenses, to people? And I'd say, again, this is a broad statement, but most real estate people aren't accountants. They don't fully understand pooled fund accounting, accrual, and all the different things that go into the accounting treatment of a pooled investment fund. So occasionally that's true, where they have somebody on staff that has that skill set, but the vast majority of them really don't understand it and don't have an appreciation of what it really means. And because it's so far outside of people's wheelhouse in terms of what they're good at, it's just not the best idea to try to go into that blindly and try to figure it out on your own. It just doesn't, especially when you can hire it and it becomes a fund expense. And I'd say it's, that fund expense reduces the income to the investors. So it's being paid for basically by the investors typically in the fund, but investors are willing to bear that cost because they know that having a third party who is doing it properly, who understands and is qualified to do it, is worth the cost to those investors to make sure that it's being done right and to provide some additional oversight on the financial, running and execution of the fund. So to me, it makes perfect sense to do it. I mean, the whole reason Verivest started doing it in the first place is when we were first doing these advisory engagements to help people set up funds, people figured out really quickly once they launched how hard it was and how unqualified they were, right, to do it, and asked us for their help. And because we had done it for years, look, and we were no different than a lot of people in there. We did our own administration early on. Well, certain funds are easier to administer, but we got good at it, and eventually we built a whole practice. And now we have whatever it is, 30 CPAs and fund accountants and people, right, that do this work on behalf of our clients. So this is an easy thing to outsource that just makes perfect sense for both the manager and the investors, across the board. Like, it's not the same as trying to do property management or overseeing construction or leasing and things that real estate people generally have some skill sets in, right? So that's my take on the basic formula for fund administration.
And I did not say this earlier, but we're coming up closer to the end. So if anyone has questions, feel free to type those in. We have a few in there right now that we'll answer just in a moment. So yeah, if you have questions, please put them into the question box and we'll try and get to those in a moment. So investor relations, this comes up during our discussions with people considering a fund and wondering, should they start building that out ahead of time? So I just wanted to maybe touch on this briefly to frame for people what investor relations is, whether or not you need that function before you launch a fund or as you launch a fund. A lot of people try investor relations and capital raising. There's a little bit of an overlap, but they're not necessarily the same thing. So, I mean, for me, I think of investor relations almost as a customer service for your investors, someone that's onboarding them, helping them with their documentation, helping them go through the investor portal, presuming you're using one, helping answer questions about statements, putting on investor events, dinners, meetings, whatever it may be. So I don't know, Matt, how you feel about this, but my take is you don't really need an investor relations person or department necessarily up front. You probably have yourself or a partner or someone in the office that can cover it as you're starting off. But as you get more and more investors, that does become a need, unless you have a bent to wanting to handle that yourself, which most managers don't. So, as you get a lot of investors and the volume grows, I think there can be a need there, but not necessarily something to worry about before launch.
Yeah, I would agree with that. I think typically if you've done what I've described, where you have a partner that's heading the capital raise effort, that person can generally handle the investor relations until the fund reaches a certain magnitude. But eventually you do need to have people that can answer questions, walk them through statements, help produce, updates and reports and so forth on a quarterly basis or whatever frequency you're doing. So I don't think it's a requirement right out of the gates, but it does become more necessary as you scale.
Okay. So that kind of brings us to the summary, and then we'll open it up to some Q&A. But yeah, just things that we touched on, who should start a fund, who should not start a fund, the type of team that you need around that, the different economic considerations, administration, real estate, or excuse me, investor relations. And so those are the things to kind of think through. That's a big part of what we are doing at Verivest is happy to chat with people if you're just wondering whether or not a fund makes sense. Kellen Stevens, whose information is here, that's what he's talking about all day on the phone. So if you want to chat about it, reach out to Kellen. Again, there's the fund readiness audit that you can find on our website. It's free. Just 30 or so questions you can fly through to get a sense there. You can run a quick financial model on the website for free as well. So with that, we have a few questions, and some of them we'll go through here. So who manages the money is a question. Does it require a full-time accounting staff? You as the manager are kind of touching the money. Your administrator, I suppose some administration companies probably do touch that money. Verivest in our administration business, we don't touch the cash. So we have read-only access into the bank accounts, but ultimately it's up to the managers to manage the cash and the money.
Yeah, well, and typically, like in some of our funds, Darris, we have a custodian that manages or that holds the capital. So it's a third party custodial account that is just one more layer of protection for investors. But I'd say the custodial accounts are pretty rare for first time managers. Generally speaking, the manager opens the bank account and the manager manages that bank account. Right, it has access to move the money and to act on behalf of the fund and all of that. Verivest and most administrators aren't touching the money; they're just tracking the money. So the fund manager is who manages the money generally, and occasionally you can have custodial accounts that can help protect that money.
Yeah, I think this is an interesting question. I'll just read it the way it's written and you can answer it, Matt. How deep is the market for groups that stake emerging fund managers, either in full or partial fill of fund capital and or fund manager operating companies?
Super shallow.
Yeah. There are not many groups doing that.
Like you might be able to get your ankle into the water, maybe. But you certainly can't swim in that pool, I don't think. I don't know of very many that do that in the small balance space, especially. I think people who I've seen do it successfully, generally, it's been personal relationships that they have, right? It's very fragmented and ad hoc, but it's either one of the partners happens to have capital and comes in with it, or they know somebody, or it's family money or something like that. But in terms of a professional systematic group, I don't know of very. That's Fairway America's business model, but besides us, I don't really know anybody out. They exist, but I don't think they do it systematically for fund managers specifically. I think a lot of it's really more on a deal by deal basis, looking to take GP slugs of individual transactions.
Yeah. We got a question here. It's kind of a legal question, so we'll disclaimer it that we're not attorneys, but it says, what about registering with FINRA and authorities?
Yeah, and I'll give my standard line of where we're not lawyers. This is not legal advice. I can tell you my best business interpretation from having dealt with lawyers for 30 years on this topic. Most of the managers will operate under the issuer exemption and be able to go out and raise capital for a fund that they're managing on their own without having to go through and become either a registered investment advisor or deal with a broker dealer. Now, different lawyers may give you different answers, but that's the answer I have heard most often from most lawyers, and I think that's pretty clear cut. If you start doing multiple funds or too many offerings and you become a serial issuer, that's a different story. Or if you get beyond certain sizes, and then look at the state level, there are different interpretations from different states across the US. So I think these are all questions that we very much encourage people to make sure you have competent securities counsel to give you advice on these kind of things if you decide you want to do a fund. And part of our fund creation process is we have several law firms that we have relationships with that we can help, bring that to the table and make sure that you have the right counsel to guide you on this kind of stuff. But that's my best understanding of it.
Here's a question we get. What's the average fund amount that you're suggesting to start at? That, of course, the answer is it depends. I mean, it depends on what we spoke about earlier, the size of your assets, the volume, the velocity of the turnover of those assets. And then like we touched on, if it's a closed fund, you need to be able to get to the end of that. So maybe initially you start considering sizing it smaller than may seem normal, so you can kind of get into fund 2 and get to the end of fund 1 sooner than later. So a lot of considerations there as to how to size a fund. And the other thing I think people get hung up on a little bit on when or how to size a fund is they think that there's some magic to that number. But if you say, I'm going to launch $100 million closed-end fund and you only end up raising $30 million, that can be perfectly fine. It doesn't mean that you have to raise 100 million or nothing. So there's a lot of nuances to the sizing of the funds. That again,
yeah, and I think a lot of that depends on what type of assets are you doing. I mean, if it's someone who's buying, discounted notes on single family houses in the Midwest, and the average loan size is 80 grand. A $10 million fund is probably plenty. But if you're buying, apartment buildings or industrial properties and the average equity check is, $10 million, then a $10 million fund makes no sense at all. It'd probably have to be a minimum of 50 million or 100 million. So it really does depend on what type of assets you're doing and the velocity of those assets. And then to your point, Darris, it is a little bit amazing, but people do get hung up on that as to what is the amount that you're raising. I mean, at the end of the day, you put in a minimum offering and a maximum offering, but the documents will generally say the manager can go over if it wants, or it may not raise the full amount. So it's just more of a number you're putting in there to put out to the world, but you're not being held exactly to that number. That number is less important in my mind than how much what makes sense as a minimum amount of money to make a fund worthwhile in the first place. And that number can vary substantially depending on the type of assets.
Okay. All right, let's take a couple more. The approximate cost to set up a fund.
Yeah, I've seen if you go to a securities lawyer and hire them to do security, I've seen people pay as little as, the low end is probably $15,000 to $20,000. I'd say it's very common, 25 to 40. And I've seen people spend upwards of 100 or more and never get off the ground. So, but I'd say 20 to 40 is pretty normal in the legal world. With Verivest, I think it's, we charge, our base price is $12,500 for the fund creation process. We have law firms that we have arrangements with that will do fixed prices for the legal portion of it capped at $9,000. So that's $21,500. And then if you form management entities and so forth and blue sky filings, I'll call it between 20 and 25 grand. And I think that's very comparable to what people pay if you're just dealing with a lawyer. But in that instance, you don't get all of the expertise and structuring guidance that we're talking about here, because for the most part, lawyers don't consider that to be their role in the process. So yeah, 20, 25 average, you could easily get up to 50 or more.
Okay. Let's do one more. This is an interesting one, and then we'll cut it off there. But the question is, I've heard that it is typically the second fundraise before the fund manager really gets to break even operationally. And what is your opinion on that?
Yeah, I think there's a lot of truth to that. But I think it also depends on the fund. I mean, we've got multiple clients of ours, Darris, as you know, that hired us that we do the administration to this day that are well north of 100 million, and they're making a lot of money on their fund. So it's not always the case, but certainly that first fund is, I would also, and this is a great guidance, I think, for people, is I view that if you're really committed to being a fund manager, you want to do it right. I do think that considering that first one as kind of some training wheels, is a good mental approach. And not to say you want to go in and lose money, and you shouldn't go in and lose money, but sort of expect that you're not going to kill it and make your life savings and sail off to Tahiti off of one fund. Right. It's that second and third and fourth fund should be a lot more lucrative than the first one, because like anything in life, it's a learning experience. So I think there's a lot of truth to it. Not always the case, but I think if people have that mentality, then I don't know about break even. I think you should be able to at least, I think you should be able to set it up properly to at least cover your costs, but not get filthy rich off the first fund. That's for sure.
Yeah, exactly. Okay, well, we have a few more, but we'll end it there. I appreciate everyone joining us today. We're going to do another one of these. I think take July off because of some travel that's coming up, but we'll be back soon with another webinar and some more. But Kellen Stevens' information is here on the screen. You can reach out to Kellen via his email, kellen.stevens@verivest.com, or give him a call. There's also a lot of information and ways to contact us on our website. You can reach out to Matt or myself on LinkedIn is a good way to connect with us. Matt does another LinkedIn Live where he talks directly to fund managers. So that's kind of interesting if you want to check that out. And so yeah, any final words, Matt?
Yeah, I saw there's a few other questions that we weren't able to get to, and for any of the folks that asked those questions, feel free to give us a call. I'm happy to chat through the answers to those. So there's some good questions on there. So yeah, happy to have those conversations. And I think you'll find our approach generally is, don't be afraid to talk to Kellen. We're not going to try to sell you something. We're not going to try to push products or services on people that don't need them. Our approach is very much trying to be as helpful as possible in terms of, does it make sense? Does it not? If it does make sense, then yeah, we'd love to do business. But if it doesn't make sense, we'll tell you point blank, our best answer at any given point in time. So yeah, don't hesitate to reach out. Happy to be as helpful as possible.
All right. Thank you, everyone. Have a good rest of your day.